There are a number of looming unknowns that will continue to weigh on investors' minds through the end of this year into 2019. First is whether things are truly different with emerging markets this time. Have EM countries resolved their debt problems? Or will progress toward reform and growth stall out again? Next is global trade and the impact changing new tariffs may have on global economies and inflation. Geopolitics are also proving to be quite unsettling, with US-Iran relations deteriorating sharply. Perhaps the biggest unknown for the longer term is how the US midterm elections will impact sentiment in the US and shape future policy, regulation, and legislation. These are all potential sources of market volatility. The uncertainty forces investors to focus on the risks they're taking and how they're being compensated. Looking forward, we think the market could provide more opportunities for flexible, fundamental investors to find value.
The U.S. economy has been running strong, and Fed rate hikes should continue if the economic backdrop stays solid. The Fed is targeting a neutral policy rate that will leave room to cut should the economy begin to disappoint, or raise further if inflation starts to run hotter than expected. Meanwhile, the market is watching for signs of yield curve inversion, which often signals that a downturn may be just around the corner. While we see economic growth slowing a bit from current levels, an actual contraction paired with an inverted yield curve seems unlikely over the next few quarters.
So far this year, global markets have absorbed tightening financial conditions and a lot of geopolitical noise. Negative events in Turkey and Argentina and rising trade tensions have added to market jitters. Underneath the headlines, I continue to see resilient global growth of close to 4%. This backdrop should generally support emerging market corporates, and I expect leverage to be stable or declining for the asset class in 2018. Default expectations for outstanding high-yield emerging market corporates are holding steady at under 3%, despite some unexpected defaults in China. I believe EM debt valuations are compelling following the negative returns in the first half of the year. However, in this volatile global trade environment, investors may want to employ an up-in-quality approach.
Markets are squarely focused on understanding and anticipating the effects of U.S. trade policy. What kind of tariffs could the U.S. implement and when? But even just talking about tariffs is enough to damage economic activity, particularly for countries in which trade is a big driver of growth. No wonder then that countries are pivoting toward other trade partners. In the last few months, the EU, Japan, China, and Mexico have all undertaken fresh initiatives with trade partners other than the U.S. in order to protect global supply chains if the U.S. pulls back, potentially to the detriment of U.S. companies and consumers.
Year to date, the senior loan market has returned over 2%. We believe it's still a good time to lend money to corporate America because credit fundamentals remain healthy and default forecasts are benign. Technical demand has been a positive in the senior loan space, but not overwhelming. We would likely see senior loan prices climb above 101 if the market was overheated. However, the average price on the index remains below par. With a compelling yield and likely rising rates still ahead, we think loans are worth including in your asset allocation plans.
Stocks have posted moderate gains this year, while earnings growth has been even stronger. Trade concerns have been top of mind, and we don't think that will end anytime soon. As companies comment on their outlooks for the second half of 2018, supply constraints and trade issues could nick profit margins. Overall, earnings outlooks should be strong, but year-over-year earnings growth is likely peaking here and will decelerate to more sustainable growth rates in 2019. Historically, stocks tend to be choppy prior to midterm elections. Uncertainty may lift somewhat after the election, potentially setting up a traditional year-end rally.
We expect the economy to continue to perform with steady growth, and investors are keeping an eye on any acceleration in growth or inflation expectations. The Federal Reserve is already tightening monetary policy, which brings concerns about the impact of rising interest rates on bond portfolios. Shorter duration investments, especially ones with yields in excessive duration, could provide attractive, risk-adjusted returns in an environment where the economy is healthy, corporate bond spreads are well behaved, and interest rates are rising.
Over the last couple of years, growth in the Chinese housing market drove up commodity prices, which helped growth in several other emerging market countries. Chinese commodity imports are now slowing down, which could impact EM commodity exporters in the second half of the year. Most EM countries are experiencing slower growth and moderate inflation. This is likely to keep their central banks on hold during the second half of the year. With rates heading higher in the US, EM currencies should remain weak relative to the dollar. We think EM monetary policymakers could accommodate weaker currencies to offset moderating growth and slowing export markets.
Strong security selection is key in an environment featuring rising rates, rising volatility, and higher inflation. Investors should find income buffers to help achieve attractive total returns. These late cycle characteristics are likely to continue through the remainder of 2018 and beyond. So diversifying your asset mix and keeping a focus on quality and yield may prove to be a beneficial course for investors.
Rising interest rates and positive equity returns help many pension plans improve their funded status in the first half of 2018. With the average pension plan funding ratio now around 90%, corporate pension plans are in their strongest position in a decade. As we look to the second half of 2018, we believe that the de-risking trend will persist and plans will continue to shift allocations away from risk-seeking assets and toward liability hedging assets. We also believe that if the credit spreads continue to widen, the de-risking trend could accelerate as some plans take advantage of attractive credit valuations.
Although the general economic backdrop remains favorable, we have a cautious view of the global automotive industry. In particular, there is heightened concern over the potential implementation of tariffs and retaliatory tariffs by various governments around the globe. If a global trade war ensues, all industry participants, including automakers, parts suppliers, and auto dealers, will be negatively impacted to varying degrees. Meanwhile, a longer-term risk for the industry continues to build. That is the need to invest heavily in the radical technological transformation that could eventually lead to widespread adoption of electric vehicles, fully autonomous cars and trucks, and a significant increase in ride-sharing options.